Chapter 14, Starting Early, Retirement and Estate Planning. Here are the learning objectives. So your retirement years may seem a long way off right now. However, it's never too early to start planning for retirement. Planning can give you a sense of control over your future. Why is it important now? So myths about retirement. You have plenty of time to start saving for retirement. Nope. Saving just a little bit won't help. Also not true. You'll spend less money when you retire. Could be true. My retirement will only last 15 years. Hopefully that's not true. You can depend on Social Security and a company pension to pay your basic living expenses. Also not true. Your pension benefits will increase to keep pace with inflation. That does not happen. Your employer's health insurance plan and Medicare will cover all your medical expenses when you retire. That also doesn't happen. So saving smart for retirement, even a little goes a long way. Start now. Time is critical. If necessary, start small. You could save $20 a week. $20 a month would still put you in a better position when you retire. Use automatic deductions from your payroll. Save regularly. Be realistic about returns. If you change jobs, keep your old retirement account or roll it over to a new one. Don't touch your savings early unless you absolutely have to. Here are some examples of retirement savings at different age levels. So if you take advantage of the time value of money and you start at age 25 and you invest $127 a month, when you retire for 40 years, so at age 65, when you retire, you'll have $1,092,000 for retirement, which would probably do what you needed it to do, correct? Okay, so let's say you start at age 50 and you invest $2,244 per month. That's over $500, about $550 a week. At the same amount of interest rate for 15 years. So until you're 65, you would have about $1,020,000. So see, you could save a lot less money for just a longer amount of time and end up with still more money than saving $550 a week for 15 years. It's a good idea to review your assets on a regular basis. Your assets would be your home, your car, anything of value, your property that you own. You may need to make adjustments in your savings, spending, and investments in order to stay on track. So specifically, housing, life insurance, and other investments are what you really should be paying attention to. You can't predict exactly how much money you'll need when you retire. You can estimate what your basic needs will be. Even a 3% rate of inflation will cause prices to double every 24 years. So 4 major sources of retirement income are employer pension plans, public pension plans, personal retirement plans, and annuities. We'll talk about what all of these are. So employer pension plans. Most employer pension plans are one of 2 basic types, defined contribution plan and defined benefit plan. So defined contribution plan, the most popular one is a 401k. Through your employer. 401k, employees contribute and employers contribute. But then there's also defined benefit plans, and that would be a pension plan paying retiree a monthly amount during retirement. Sometimes that monthly amount can be like a percentage of your monthly pay that you were making close to the time that you retire. And then there's employer or pension plans. There's federal government insures your pension and allows your pension to follow the employee when they switch jobs. Then there's public pension plans, such as Social Security. So Social Security eligibility, you can get full retirement benefits, Social Security benefits at age 70. Depends on year of birth. Reduced benefits at age 62. Full retirement age being increased in gradual steps. Benefits based on earnings over the years. Must earn a certain number of credits to qualify. So you have to be paying income taxes for a certain length of time before you can even qualify for Social Security. And then certain dependents may receive benefits as well. Other public pension plans, there's the VA, state and local governments also provide public pension plans. IRAs are important to self-employed people and other workers who are not covered by employer pension plans. So that's what a personal retirement account is, an individual retirement account or an IRA. We also have Roth IRAs, and that's the same as a regular IRA. However, you put money into it after you've paid taxes. So a benefit to that is when you do retire and you pull money out of that for your income, you don't have to pay taxes in retirement because those taxes were already paid. And then there's also IRAs for small business. There's simplified employee pensions and spousal IRAs. There's also rollover IRAs, education IRAs, IRA withdrawals. Code plans, limits on personal plans. So here's a table describing the different types of IRAs. So annuities, we've talked a little bit about annuities when we were talking about life insurance, but I'm going to tell you a little bit more about them. Annuities provide guaranteed income for life, purchased with proceeds of an IRA or company pension. So when you go to retire and you have that large amount of money saved up, you can use that money to purchase an annuity so that you're guaranteed some income for life. Or you can use a supplemental retirement income. So you can just use a portion of that money that you have saved up to purchase an IRA. Moving on, living on retirement income. You have to estimate a retirement budget. So that can sometimes be difficult to do. You know, I'm 43 right now. I have no idea what I'm going to need in 22 years when I retire, or 27 years whenever I fully retire. So it's you have to keep reevaluating and keep looking at that. I hope that I have my mortgage paid off by then, so I wouldn't have to pay for housing. That would be ideal. But it's hard to know. That's why you need to keep evaluating that. So if funds are not enough, first you want to make sure you're getting all the income you're entitled to. Make sure when you do retire that you're applying for your Social Security benefits. Make sure any pensions that are out there that are owed to you are being paid. You might want to convert some assets into cash, or so maybe you have a camper that you're not going to be using anymore. You may want to sell that. Maybe you have multiple vehicles and really you only need one. You may want to sell some vehicles. So you'll have to figure that out when the time comes. Convert assets into cash. Okay, consider the trade-off between spending and saving. Consider working during retirement. So all of these things you'll have to consider leading up to retirement to make sure that you have enough when the time comes. Many people think of estates as belonging only to the rich and famous. The fact is, everyone has an estate. Creating an effective estate plan will allow you to prosper during retirement and provide for your loved ones when you pass on. So when you pass on, the person handling your affairs will need to access all of these documents, these legal documents, the birth, marriage, and divorce documents, legal name changes, military services, Social Security documents, veterans documents, insurance policies, all of that stuff needs to be available to whoever is taking care of things when you pass on. You should avoid the possibility of dying intestate. So dying intestate means without a will. You have 4 basic types of wills. The differences among them can affect how your estate can be taxed. So there's a simple will, traditional marital will, exemption trust will, stated amount will, wills and probate. No matter what type of will you choose, it's best to avoid probate. So probate is when all of your things go to court and then the court decides who gets them. It's a lengthy process, and it's an expensive process, and you really don't want strangers making those decisions for your loved ones. And then there's 3 will formats. There's a holographic will. Michigan recognizes a holographic will, by the way, and that's a will that you write, date, and sign entirely in your own handwriting. There's a formal will, and then there's a statutory will. Writing a will is the only way to ensure that all of your property will end up where you want it. Writing your will, selecting a guardian. So it is important if you have children that you include that in your will, who will take care of your children if something happens to both of the people that are responsible for the children's care. Once you've made a will, review it frequently. At some point in your life, you may become physically, mentally, or mentally disabled and unable to act on your own behalf. So a living will would be something that you would need. Sorry about that. If you are active online, you should consider creating a statement of how your online identity should be handled. Do you want all your Facebook, Instagram, all of that to remain open? Do you want them to be transferred to a memoriam? How would you like that to be handled? And then a power of attorney is a legal document authorizing someone to legally act on your behalf if you become seriously ill or injured. It's much like a living will. When my dad when his health was decreasing, we did this. So I actually had, my sister it was his medical power of attorney, and then I was his financial power of attorney. So I handled all of his financial matters, and my sister, who's a nurse, handled all of his medical matters. Writing your will, letter of last instruction. It's not legally binding, provides heirs with information, could include funeral preferences, name of person to be notified of your death, location of bank accounts and safe deposit boxes, assets and debts, Social Security number, disposition of personal effects, how you want your heirlooms to be handled. We had my father do this. So I told you a little bit about my mom died and she was hit by a drunk driver. When I was in my 20s, she was 48, And so that was a sudden death, and we didn't have any plans made for her at all. So with my dad, he had had a illness almost his whole life. He had polio and was in a wheelchair and had a lot of health problems. We made sure all of these things were handled before he passed away. So we knew what funeral home he wanted to be at. We knew we knew what cemetery he wanted to be at. We knew all of the things that he wanted included in his funeral. We had his life insurance paperwork. I mean, all of that stuff we already had taken care of before he passed, so that we didn't have to worry about those details when we were mourning. So trusts. A bank charges a small fee for its services in administering a trust. So a trust is a legal arrangement through which a trustee holds your asset for your benefit or that of your beneficiaries. So when is it important to have a trust? When you can't just when you have special circumstances, when you have people you want to leave things to, but that maybe not able to handle those things. So it could be if you have like a mentally handicapped family member that you want to make sure they're taken care of, you would need a trust to do that. Or maybe you have a family member that has problems with mental illness or drugs or alcohol. So you want to make sure that they are taken care of, but giving that family member a huge amount of money right off the bat might not be in their best interest. So in those situations, you would want a trust. Or maybe you want money left to your grandkids, but you want that money to only be spent on their education. Or so if you have any special conditions with your will, then it's best to move to a trust and have that handled. Or maybe you just have a lot of money. So if that's the case, then having a trust so that you can really identify exactly how you want that handled in your passing, a trust is the best way to do that. All trusts are either revocable or irrevocable. An estate attorney can advise you about which trust best fits your needs. There's also credit shelter trusts. There's disclaimer trusts, living trust, testamentary trust. So federal and state governments impose various types of taxes that you must consider in estate planning as well. So estate taxes, I'm sure you've heard of the death tax or estate taxes. Well, your first $5.49 million that's left to your family members after you die is not taxed. So the estate tax and the death taxes only applies to people that have $5.5 million or more when they pass. That's probably not going to be the case with me. So when you hear a lot of talk about death tax and estate taxes, that's usually only an issue for millionaires. So that's not anything we really need to worry a lot about when you're talking. You'll hear that be brought up a lot with politicians, and whenever it is, I'm always rolling my eyes like that doesn't apply to me. And then inheritance taxes and gift taxes. And that is it for this chapter. Thank you.